When you look at the US, the overnight rate's at 4.5%, and you compare that to Canada, Canada's at 2.75, ECB's at 2.15. So there's more room to cut. But I would argue that the US, in terms of their economic situation, it's far more robust down there. GDP is at 4.5%. Inflation's CPI is at 2.7%. So it's a different monetary policy for a different environment. Also, with just a lot of the uncertainty that's coming up with the tariffs, big, beautiful bill, if we do see inflation, then let's say, Powell goes ahead and cuts 50 to 75 basis points over the next 6 to 9 months, all of a sudden you see inflation creep up from 2.7 to 3.2% or something higher, then that differential between your overnight rate and inflation isn't going to be that significant anymore. And then for the Fed to kind of reverse course from cutting interest rates to hiking interest rates, I don't think it's a good look, rather, because it destroys their credibility, but it also creates a massive shock to the system.
Hello and welcome back. This is Insight is Capital, and I'm your host, Pierre Daly. There's a certain quiet authority that comes from building something from the ground up, and Alfred Lee has done exactly that. Now Deputy Chief Investment Officer at Q Wealth Partners, Alfred brings more than 2 decades of market-tested experience to the table. Before joining Q Wealth in 2024, he spent 14 years at BMO Global Asset Management, where he helped launch and grow the BMO ETF platform from zero to over $100 billion in assets. Known for his deep technical knowledge and ability to translate complex strategies into practical solutions, Alfred's fingerprints are on everything from fixed income and factor-based ETFs to pandemic-era bond purchase programs. In a field that prizes both innovation and execution, he's built a career delivering both.
This is Insight is Capital. Join us in our fireside chats with some of the most fascinating people in finance to discuss their insights on life, markets, macro, investment strategy, and much more.
Alfred, welcome. It is great to see you again and have you back.
Yeah, no, it's been a while, but definitely looking forward to this and catching up.
Likewise. Thank you. So, Alfred, before we get into your take on markets, which I'm anticipating everybody wants to hear, tell us about Q Wealth and your role there and what made it a compelling choice for you to join the firm.
Well, I'll start off with just, talking about what Q Wealth is. So, in the U.S., there's been this huge movement towards independence. This RIA movement, right? So registered investment advisors, where I think after 2008, a lot of advisors and portfolio managers have wanted to go independent. So essentially moving away from a lot of the wirehouses, so the Citibanks, the Goldmans, the JP Morgans. As you know, in Canada, the trends tend to lag the US by about 10 to 15 years. So that independence, we haven't really seen in Canada, right? But now it's starting to take that form. So we are starting to see that hockey stick in terms of advisors wanting to move away from banks and truly seeking independence at this point. So, our business is essentially the Canadian equivalent of an RIA aggregator, where we essentially provide, turnkey solutions in terms of the operations, the legal framework, the compliance, the technology stack, the marketing, and most importantly, the investment platform and the asset management as well, right? So we've been growing quite a bit. I started September of last year, so just a little bit shy of my 1-year anniversary right now.
Right.
So I started with $3.5 billion in assets. We're at $5.5 billion right now. We're probably going to finish the calendar year, somewhere between $7 billion and $8 billion. Our business development team has been on just absolutely busy. They've been fielding a lot of inbound calls now where people are starting to inquire about Q Wealth at this point. So it's been, we're just about to hit that hockey stick in terms of growth. So my job as the deputy CIO is essentially working with our current CIO and co-founder Larry Berman in creating the investment platform, right? So creating the asset management side of the business. So that's everything from creating the foundation. So we spent the last 11 months creating the foundation so we could scale up, but also creating the solution shelf, creating, what the value proposition is and articulating that to clients. So first year was all about setting that foundation. Now as we enter, my second year, now it's about getting that communication out and articulating what that value proposition is to the partners and prospective partners, but also end clients as well.
Yeah, and by partners, you mean advisors.
Yeah. So the structure of our business is essentially a partnership. So when they join Q Wealth, they become a partner. So that's why we call them partner firms rather than advisors.
Yeah. So now coming on board as Deputy CIO at Q Wealth, one of Canada's leading independent advisor platforms, how has being in that environment shaped the way that you approach research and portfolio strategy? Do you feel more freedom to challenge consensus or explore areas that might have been off limits or out of bounds in a traditional setup?
It's a good question. I would say there's more freedom in ways. But from my background before, I never really felt that I was told to push one thing or not to talk about certain things. I think the luxury that I had was we essentially worked at a startup that was backed by the bank, which was BMO ETFs or in the early stages. So the good thing is that we built such an expansive product set that, as we had broad-based solutions, we had very targeted solutions. So we were always, we had products that essentially, no matter which way the market went, there was always a conversation that we could have. And it was always an honest conversation. The limitation, however, is that, when you look at the ETF industry or not the industry, but the ETF structure itself, it's a great solution for the public markets. And I'm a huge advocate of ETFs, as you know, and I always will be. So how our business is structured right now is that we offer private pools. So they're not exchange traded. Maybe at one point we will offer ETFs at some point. But right now everything's a private pool. So the beauty of that is, we have everything from the public markets perspective. So,
right.
Across that active risk spectrum, we have enhanced beta, we have factor-based solutions, we have active managers. But on the public or the non-public space or the private space, we have a private equity fund, a private debt fund, a liquid alts fund. And a lot of these kind of exposures don't work very well in an ETF structure because, when you look at private debt, for example, when I commit capital to a private debt manager, they have to put that capital to work and they don't have to worry about redemptions in order to properly invest in the business, right? So I think in an ETF wrapper, it's not exactly the best structure for, the private space. So in ways, the Q Wealth kind of solution shelf is a lot more broad. I mean, we don't have those targeted exposures like sectors, for example, but it is more broad when it comes to having all the tools to build a proper portfolio. It is a lot more expansive because it has the private exposures.
I was just thinking while you were, talking about your experience, and what's interesting is that, you really played an instrumental role in building what has become an agnostic platform at your previous employer at BMO. One of the advantages of your career is that you did play an instrumental role in bringing, all possible options to market, not just one small suite of ETFs, but an entire comprehensive suite of ETFs that could address almost any challenge, diversification challenge, portfolio allocation challenge that arose. And so now I think maybe what's changed is that now, like, in addition to the offerings that are on the shelf at Q Wealth, including the private offerings that you just mentioned, you're also in a position to comment and advocate for portfolio construction that encompasses all issuers, right?
Yeah.
Not just, you're no longer limited to, as a strategist, I mean, you're no longer limited to discussing the comprehensive suite of ETFs that you once had a role in building. Now you have the freedom to talk about all ETFs, absolutely the entire market. So that's probably the biggest change that's taken place in your in your ability to build strategies.
Absolutely. I mean, we do have an ETF fund, for example, where we can invest in essentially any ETF out there, right? So both Canadian listed and US listed as well. So we're definitely looking for more opportunities in terms of, partnering with ETF providers and partnering with other platforms where we could launch, more ETF related strategies. But we also have internal pools as well that could, invest in ETFs. But also, if there's not an ETF that provides that exposure, we have private pools that essentially are built around like private debt, private credit, for example. We have an alternative strategy that we partnered with AQR, for example. So there's a lot more exposures that our partners have exposure to, whether it's internally built or externally built.
Alfred, I think we may have discussed this first part of the question, but I did. From your vantage point, what's the biggest difference working within an independent platform like Q Wealth versus a legacy institution? Has it changed has it changed what you prioritize in your work, or even how you define investment success?
It's a good question. So I think, if you look at my resume, for example, I essentially grew up in the banking community, right? So having worked at 3 large Canadian banking institutions, I think, as I kind of alluded to before, I mean, one of the luxuries is that, my last 14 years at BMO, it was essentially an entrepreneur kind of culture, even though it was kind of, backed by the bank and known by the bank, but it was a very entrepreneurial kind of startup feel, especially at the beginning. I think I got the luxury of working with very talented leaders that allowed us to do many different things, and also working with a very talented team that was, responsible for building the entire ETF business there as well.
Right.
But in terms of, the differences between, BMO and here, I would say it's very similar in many ways, because, that hustle in terms of, the ability to wear many different hats. I remember in the early days, there's 5 or 6 of us in one closet, and it's like, who wants to do this? And then people just put up their hands, right? But it's almost the same kind of culture here, where, if you have a defined role and something kind of falls outside your purview, you just roll up your sleeves and get it done, right? It's very much about that hustle culture here, which I like. But in terms of, how we define success, it's very much the same thing, right? So my philosophy and what really appealed to me at Q Wealth is it's always the client first, right? I think, the philosophy is always, do what's right for the client, look after the client, and the rest will follow. So it's very much the same culture here. I think a good thing is that Q Wealth is a registered portfolio manager. So we have the fiduciary responsibility in terms of, creating the best portfolios and putting the right solutions in our clients' portfolios, whether it's internally built or externally managed or an external product, right? So, even when we create our solutions, my philosophy is that we have to earn those dollars. We can't just put it into clients' portfolios, especially as a fiduciary. The way I view it is, if we create a solution or a fund, we're out there competing with the BlackRocks and the PIMCOs of the world, where it has to be an equal solution from an investment perspective, if not better, cost competitive, if not better, and also, that storytelling or that communication to the end client in terms of, talking about that value proposition, it has to be equally better as well.
It's not hard to see. It's not hard to understand, like, why Q Wealth, brought you on board, and you have this incredible compounded knowledge of having not only been there for, the formation of your, in your past career setup, but also having that entrepreneurial spirit, and then now bringing it to Q Wealth, where you have a whole new group of really incredible leaders to work with. So I'm sure, they must be excited about what you're bringing in, but equally, you must be very excited about what the future holds for your career.
It's a fantastic opportunity because, as you mentioned, I've known you for probably over 10 years now. And as we know, very passionate about the markets, very passionate about portfolio management, investment strategy, but I'm equally passionate about the business building and the whole kind of getting the ability to build an asset management business from the ground up. And this essentially was a blank canvas to work with. And as you mentioned, great leaders, great executive team, and great people here and great culture. So it ticked a lot of boxes.
Yeah. Well, Alfred, we love the spirit of what you're doing. It's fantastic what Q Wealth is doing. Let's talk about markets right now, because the markets have been kind of dicey this year. At least it felt that way. We had a lot of uncertainty. We still do. You've described the current market setup as constructive, but not without its complexities. The sun is shining. I mean, unexpectedly, I think even in the midst of all this uncertainty, markets have continued to rally forward. Most equity markets, the ones that matter to us the most, are at all-time highs. In your view, what are investors getting wrong? What may they be getting wrong about this moment? What risks do you think they're not paying enough attention to heading into the second half of the year?
Well, I think, when you look at the market right now, I think you raise a good point, right? It just seems like it's just shrugging everything off at this point. I think that's partly due to when you look at all the different asset classes out there, especially in the public market, there is a lack of viable alternatives out there, right? So you look at bonds, for example, there's inflationary concerns, especially, on the long end of the curve, which, yields continue to go up. So it's not exactly you don't exactly want duration risk in your portfolio at this point, right? And that's coming from a former bond manager.
Yeah.
But also, when it comes to cash, if you are thinking about where overnight rates are, President Trump, trying to put pressure on Powell in terms of cutting rates as well. So cash isn't an alternative solution either, especially with inflationary pressure. So it's almost like equities is that default kind of answer at this point, especially if you only are looking at the public markets.
Right.
But, we kind of headed into 2025 and, we put an outlook report at the top of the year thinking that, the equity returns, let's use the S&P 500 as the benchmark. We were expecting, high single digit to low double digit returns. Obviously when the Liberation Day hit, we're like, okay, maybe we got this wrong and maybe we're going to see negative returns. But, after 20, 25 plus returns on the S&P 500 in the last 2 years, the likelihood is that we're not going to see that again, right? So, we still kind of stand by that call. We don't really factor in calls when we create portfolios. The way we create portfolios is almost like an institutional approach where, we try to figure out what are we trying to deliver and what's the most efficient way of delivering that, whether it's 8% annualized returns or whether it's tax efficient returns. And then we create portfolios that are resilient no matter what the markets do, right? But in terms of client communication, it's important to tell clients what markets are doing and have an expectation in terms of what to expect as well. So we anticipated, again, high single digit, low double digit returns, but there are risks in the markets like tariffs, valuations, geopolitical risk as well. So those are the concerns that we have heading into the second half of the year.
I think the key, the one elusive idea that seems to be quite pervasive is the idea of building a portfolio that's prepared, not taking a particular direction of any kind, but prepared for all potential outcomes. Mm-hmm. And having components within the portfolio that will provide resilience one way or another, no matter what happens. I mean, if the market continues to rally, then so be it. The equities continue their trajectory. On the other hand, if we have some event or whether it's economic or exogenous that affects the market, or debasement concerns, all these different concerns that are compounding right now and seem to be getting shrugged off, as you said, are still there. They're just like underneath that. There's this strong undercurrent of uncertainty still underneath it all. And markets do climb a wall of worry. They have this year. Your outlook suggests we're moving away from a market driven by momentum to one where fundamentals take the wheel. And, what does that shift mean for advisors on the ground, and how should they be thinking differently about asset allocation right now?
I think it's more so to do within certain asset classes, right? So within equities, for example, and when you look at the sell-off that we saw due to Liberation Day, it was really driven by higher beta stocks, right? So it wasn't unlike any kind of market sell-off. It wasn't that atypical. Higher beta stocks tend to be more cyclical in nature, and they tend to be more sensitive to, what's going on in the economy. So obviously, those led the sell-off. And then as we kind of recovered since the beginning of April, it's a high beta names that kind of outperformed, right? So we actually dissected the S&P 500 into different beta buckets. And what you found was the higher beta stocks clearly outperformed since the beginning of April. And those low volatility stocks that actually didn't fall have been relatively flat since the recovery as well. So, when you look at these high beta stocks, I don't think that momentum can continue on forever, right? So I think at some point we're going to have to rotate into kind of like higher quality stocks, maybe to a touch of lower beta stocks as well. Right. Especially if we start seeing these inflationary pressures, right? So if we start seeing big, beautiful bill in terms of the fiscal policy, the inflationary pressure kick in there, especially in addition to the tariffs as well. If you look at higher quality stocks, they tend to have more fiscally responsible balance sheets, more defendable business models as well that are going to be more resilient in an inflationary environment. So I think a lot of the rotation is more so to do within the asset class. From an asset allocation framework, we need to be very consistent in terms of, as you mentioned, spreading out exposures across different factors and different asset classes as well.
Yeah, I think the tough part, of course, with diversification, even like within each respective sleeve, is, for advisors, it typically is the discussion around, let's rebalance away from the winning part of the portfolio to some of the more attractively valued parts of the portfolio, or attractive in terms of quality or low volatility or dividend payers. Like making those adjustments is probably the biggest challenge advisors face. And of course, I mean, taking to some degree for granted the fact that, clients have entrusted their advisors to make those decisions for them. It doesn't go without notice if the allocation decisions were wrong 6 months or a year from now, right?
Yeah.
But I think one thing that I wanted to point out with regards to how you describe building portfolios, one way I sort of learned to look at it, a perspective on portfolio construction, was to start with the idea that you don't know what's going to happen at all. Mm-hmm. So you're not building a portfolio based on, you think interest rates or long-term yields are going to continue rising. So, let's not take a particular direction in fixed income or higher duration bonds or those types of assets, or you think that, the Mag 7 is going to it's going to continue to rally and continue to dominate. The AI story is going to proliferate even further, and we're going to have this big rosy AI market. But rather just, what makes sense, what are the components of a resilient portfolio, what other assets besides equity and bonds can provide that, the smoothing, the diversification, even the counter volatility against those core assets, their traditional equity bond portfolio. And that feels like the environment we're in right now, and that feels like the time advisors should be really making the adjustments to their portfolios is now. Not you don't want to wish you had diversifiers in your portfolio after the market turns, potentially for the worse. You want to do that ahead of time, but you don't want to do it. You don't want to do it just because you think that might happen. You want to do it in a constructive way where you do have that counterbalancing effect of assets that are uncorrelated, counter volatile, provide that ballast that has been hard to define right now beyond bonds. There are some positive economic events on the horizon, like the one big beautiful bill. which is putting promises to put real money into the system. But at the same time, to get into that fixed income question, inflation is still lurking in the wings, in the background. How do you see the push-pull dynamic, which is really like a conundrum right now in terms of what advisors and investors should do, between fiscal expansion and monetary caution playing out, especially for those fixed income investors, or even those investors who are, at the fringe or at the edge of that fixed income market?
Yeah, that fiscal expansion, I think, as to your point, I think is going to be stimulative for the economy. But on the flip side, it's going to add a lot of debt, right? So I think that was a lot of the pushback, even with, I think, some dissenting Republicans that voted against it as well. But I think that's, the balance that monetary policy has to play at this point. And I think that's why we're getting a lot of friction between Trump and Powell at this point. Trump obviously wants to lower rates because he wants to refinance at a lower cost, but that's going to be inflationary, which is over time going to have to cause you to issue more debt. So it's going to add to the debt base anyway, just in a different way.
Right.
But just in terms of that push-pull dynamic, we're also seeing that push-pull dynamic in the political spectrum as well, right? So Trump versus Powell. But I think, if I were to look at it, I actually think Powell is taking the correct stance here, right? And the reason why I say that is because a lot of people are saying, well, when you look at the U.S., the overnight rate's at 4.5%, and you compare that to Canada, Canada's at 2.75, ECB at 2.15. So there's more room to cut. But I would argue that the U.S., in terms of their economic situation, it's far more robust down there. GDP is at 4.5%. Inflation's CPI is at 2.7%. So it's a different monetary policy for a different environment. Also, with just a lot of the uncertainty that's coming up with the tariffs, big, beautiful bill, if we do see inflation, then let's say, Powell goes ahead and cuts 50 to 75 basis points over the next 6 to 9 months.
Yeah.
Then all of a sudden you see inflation creep up from 2.7 to 3.2% or something higher. Then that differential between your overnight rate and inflation isn't going to be that significant anymore. And then for the Fed to kind of reverse course from cutting interest rates to hiking interest rates, I don't think it's a bad look, because I don't think it's a good look, rather, because it destroys their credibility, but it also creates a massive shock to the system. So I think Powell's actually, playing it right here. I know a lot of people are talking about stagflation. And when it comes to stagflation, there's two things to address, right? There's the stag, which is stagnant in the economy, and the inflation. And it's like, if you have to combat either, I mean, you have to choose to fight inflation first, because there's only that many policy tools to address it. And once it gets out of hand, it's hard to fight, as we saw, in 2020 and 2022, right? So I think you address the inflation first, and then you stimulate the economy. So I think he's doing the right thing here.
Yeah. So slow down the horse.
Yeah, exactly.
Yeah. Not the cart. Don't upset the apple cart. Just slow the cart. Slow down the horse first.
Yeah.
Right.
Yeah.
before they they head for that stagflation collision. Interesting. Very interesting. There's been recently, I'm sure you've seen it, there's been a lot of discussion about, the around this topic of fiscal dominance over monetary dominance. And, it's probably early, but politically it looks like that's what the Trump administration is trying to muscle, their way into the Fed or into Fed policy by countering with this fiscal dominance argument, which is that we need you to make it easier for us, and it's not the other way around.
No,
right? And that maybe that's early, but that sentiment seems to be playing globally into this anti-tariff sentiment, which is like,
yeah.
Like, let's see what happens if you go forward with these tariffs and you actually lock these things down. And some of the deals that have been made trade-wise have been kind of, that's a good deal.
Yeah.
I almost feel like, I want to move on from this topic, but I almost feel like, the other leaders around the, in the global economy are looking at all this policy brinksmanship and tariff attack as something that could fizzle out potentially next year with the midterms, with, power in the White House dissipating a little bit if there's a change in the House and the Senate. But even if you look beyond that, if you go to the end of the term, we've got another 3 years left of the Trump term,
right.
and halfway into that is the next presidential election. And what's the backlash? What's the political sentiment going to be at that point, given all of these policy changes that could be done away with very quickly by another administration, by the next administration? Yeah. Whoever that is. It doesn't necessarily follow that Trumpism will dominate the White House for the next 8 to 12 years, and these changes that have taken place. So I think there's also, among in the asset management cohort, there's like, well, wait a minute, like we're getting worried that these are going to be like permanent changes forever, but 2 years from now things could change, because of the change in power, or 3.5 years from now it could change altogether. Another president can come in and wipe out all those executive orders.
Yeah, he can change his own policies as well. I mean, the USMCA, he set up, right? So he's also looking to reverse course on that one as well, or make changes. Yeah. But I do think there is a dangerous game he is playing, right? Just in terms of, as you mentioned, the midterms are coming up, and I think that's part of the reason why he wants to cut interest rates as well, right? I mean, he measures his own success based on the equity markets and also the strength of the economy as well. My concern, just taking the politics out of it, is that, my concern is that if you cut interest rates at this point, and just for the long-term sustainability of the bull market, I would not want to see a market melt up at this point, right? And that's the bigger concern. I mean, who's in the White House, I think, is less of a factor, but from an investment standpoint, you just don't want the markets to be overcooked at this point.
And to your point about it being not a good look for the Fed or for the economy for substantial rate cuts to suddenly become a policy decision, to the rest of the world, it signals that, wow, there must be really something terrible happening underneath it all in the economy. The economy must not be as robust as has been claimed.
Yeah.
Right.
I mean, yeah, just in terms of the politics, I mean, I do think it makes sense to try a different approach, but also it has to make sense for the markets as well, right? So there's been a lot of disruption. One thing, just looking back to April, I mean, the concern was that no trade deals would get done. At least we are getting some kind of resolution here, and we could move beyond that. So I think the market is pricing in some resolution at this point. We did get news of some trade deals and some reinvestment into the U.S. as well. So, we're recording this in early August. We still don't know about the China truce coming to an end on the 12th. So that potentially could be a hiccup. We don't know at this point, but, it looks for the most part that we could move beyond tariffs at this point.
It just seems to me, it seems to be that the ongoing policy right now is to continue to create fog. I mean, for every measure of clarity that comes, and it's just, like each deal that appears to be made with other countries, with other import-export deals, tariff deals, that seems to be coming across the wire, there is this continued effort as well to create other fog.
I mean, that's a strategy, right?
Yeah, it's just obfuscate. Everything is just this ongoing fog, and I think I suspect that's a lot of the reason why that's the wall of worry that the market is climbing, is this continued unidentified uncertainty. I don't know what to be uncertain about. I feel uncertain about things, but I don't know what to be uncertain about. How much of it is real? Mm-hmm. What's the guy behind the curtain doing? Right? What are they up to? And so anyways, let's move on. I want to get to talk about equities again in terms of how, you've warned that markets may be priced for perfection. And with valuations, of course, I think most people would probably agree that valuations appear to be running hot. In a setup like that, where do you see the potential for investors to find asymmetric opportunities, the kind that offer more upside than downside potentially?
Well, in terms of valuations, I mean, we wrote that report, which was the outlook into the second half. We wrote that, I think it was like 2-3 weeks ago. We didn't have the luxury of, having insight into the current earnings cycle. And the current earnings cycle is actually pretty interesting because when you look at, the companies that have reported so far, most of the companies have reported at this point, but 83% of the companies have delivered a positive surprise, right? So that tells me, it could be, people just trying to front run the tariffs or the impacts of the tariffs. So people buying more goods and service ahead of that. But when you look at how widespread, those positive beats were, right, I think it's more than tariffs, right? So that tells me one of two things, or maybe both. Earnings set by analysts were probably a little bit too bearish, right? And the other one is maybe when companies are setting their forward guidance, maybe they're being a little bit too modest, or it could be a combination of the both. So
yeah, that's true. There was a lot in previous earnings calls, like where some companies even said we're not providing a forecast.
100%, right? So
right. I mean, we don't know what's happening. We can't really, gauge it.
Yeah. So I think as a result of that, so when you look at, your PE ratio, whether you're looking at, forward PE ratio or a cyclically adjusted PE ratio, what happens is your earnings are probably skewed too low because, the price is set by the market and earnings are set by analysts and companies. So maybe the market does have it right in terms of pricing, and analysts and companies are being a little bit too bearish, meaning that earnings are set too low and maybe they need to be revised higher. So if you were to make that adjustment, maybe the earnings or maybe the valuations aren't as rich as originally thought. So, when we wrote that report, we thought the market was overvalued. I mean, there's certainly data that suggests that it still is, but after seeing the earnings cycle, I think maybe the earnings have it a little bit off where it should be adjusted higher. So maybe the valuations are not as frothy as what the data suggests. But in terms of, what offers asymmetric returns, I think the equity market, I mean, if you look at the equity markets, I think, as we alluded to before, lower beta stocks, as I mentioned, they didn't participate on the downside, but now as the market is hitting new highs, they haven't participated on the upside neither, right? So I think they're underpriced relative to higher beta stocks. So in terms of the public equity market, I think that's where you could get maybe some asymmetric returns. But I think where the real asymmetric returns is really in the private market. So, the public markets are so well covered at this point, even when you look at, some of the smaller cap names. But when you look at the private space, if you have a strong due diligence team, which we do here at QWealth, it's almost like you can unlock alpha just by having good due diligence, asking right questions. And especially when it comes to private equity and private debt, when you look at the secondary space, for example, you could buy secondary investments from people that want liquidity. So they want out of the investments just because they need liquidity. But when you look at secondaries, you already have a good indication in terms of, how those managers perform, whether that's a strong vintage or not. And you're already kind of past that J-curve effect as well, right? So I think, in the private space, that's where you could kind of unlock those asymmetric returns just by having a strong due diligence team.
It's interesting. The private space is one of those, like private equity, private debt is one of those areas that, that I think a lot of advisors and definitely a lot of investors don't understand properly. They know it exists. They just don't realize the opportunity set that's within it. Like I think one startling fact that always still, blows my mind is the fact that 87% of companies in the US, for example, that have revenues over $100 million a year are private.
Yeah.
Like opportunity there, like that's 8 or 9 times more companies that are potential investment opportunities, assuming they come to market either looking for equity or for, equity raises or debt. But for a bottom-up investor, for a fundamental bottom-up stock picker type investor, that's a greenfield of opportunity.
Yeah.
I mean, that is a vast field of opportunity. It's no wonder, the private equity market itself or private asset market itself is growing in leaps and bounds as it has been. But as I think you make an interesting point, which is that the pricing isn't in on those assets.
Mm-hmm. It's also accessibility as well. I mean, a lot of
management teams.
Yeah,
you've got management teams, consulting teams that are in place at many, in the PE space, who are adept at unlocking value. Not just it's like alchemy in a way.
100%.
You see. Wait, the owners don't even realize the people who founded the company, the owners of the company, don't even realize that this other $10 or $20 billion in valuation could be unlocked just by doing this one or two things. And then they come in and they bring that expertise, to that equation, to unlock value.
Yeah.
And then the next thing a private company that was worth $5 billion is suddenly worth $30 billion.
Yeah. And I think most retail advisors, on average, they probably only have up to 5% in the private space. So I think it's partly due to accessibility, where it's tough to access now.
It's new.
Yeah. Now
not accessible. Yeah.
Now it's new, but also, a lot of these deals, if you're investing in single deals, for example, like an LP or something, the minimum cost of entry very often is like $2 million or $5 million. So even if you have a high net worth investor that is worth $10 million, it's not like you're going to put half their net worth in one deal that could go sideways, right? So
so you need those evergreen funds, those interval funds.
Yeah. So, we have a fund that basically invests in a number of different LPs and different funds. So, it smooths out the J curve. We could unlock, we have daily liquidity where we have a liquidity sleeve in that fund, but you're also getting that diversification, right? Where, a $50,000 client is going to get the same diversification and access as your $5 million client. So that's a whole beauty of, taking private debt and private equity and structuring it in a convenient manner that makes sense for all investors.
You mentioned secondaries, and I think that potentially gets overlooked a lot as well, which is that, the first question about secondaries is why is the general partner of that holding exiting? And you mentioned liquidity, but sometimes it's just a logistical thing. They just need the liquidity. They need to rebalance. They need to unload some positions and rebalance their funds as a requirement. And because it's mandated sometimes,
and
right?
There's going to be a cost for that liquidity, right? Which is going to be taking a discount.
So when you have an opportunity to get into early, like something that has beyond that initial risk period, the J curve, initial J curve period, but hasn't really even been fully unlocked yet, but has already been proven, and is something that the previous owner can actually liquidate.
Mm-hmm.
That's pretty exciting when you consider like that the stage at which those secondaries are often being liquidated is still very early on.
It is
like not 2003 Google,
no,
but 2013 or 14 Google.
Yeah, but at least you have a few years in where you get a good indication in terms of
you can see the operating history.
Yeah, the operating history and whether that manager is good, and also whether that vintage is a good vintage as well.
So beyond the private space, the private asset space, do you see any other opportunities in the market that provide some asymmetric or in terms of allocations that provide asymmetric opportunity?
The alt space as well. I mean, we have a fund that invests in multi-strats, for example. I think that's asymmetric because it's not necessarily alternative assets, but it's alternative strategies where they could use things like long short. They could use things like hedging in order to create asymmetric returns. So that's another area as well. But in terms of, the public space, as I mentioned, it's really tough to find, those real kind of asymmetric returns just because everything is so well covered at this point.
Yeah. So, Alfred, speaking of diversification, you make a compelling case that the traditional old 60-40 portfolio that we've become accustomed to over the last 30 or 40 years may no longer cut it. So what does a resilient portfolio look like to you today in terms of the specific build? Are there specific building blocks or strategies that you think are non-negotiable in this environment?
Yeah, so I think the market has moved beyond the 60-40, right? I mean, whether it's dead or not, we could debate, but I do think it's outdated. So the market has evolved. I think when you look at 2022, that's a good example, right? So usually and the reason why 60-40 model works or used to work is because a natural economic slowdown in the past was really led by recessionary forces, yet deflationary pressures, and then your Fed playbook or your central bank playbook would essentially be cut interest rates and more recently expand the balance sheet through QE. That's a normal slowdown. 2022, we saw inflation for the first time in 30 years, right? So in that kind of a market, your policy response from the central bank is the opposite. It's raising interest rates, and sometimes very quickly, as we saw. So in that environment, you're going to see bonds and equities become highly correlated. When you look at TLT, as you know, has been known as the ultimate kind of like equity market hedge.
Right.
And you look at the correlations between TLT and SPY, for example, over the last 5 years, it spent more time being positively correlated than negatively correlated, right? So that tells you alone 60-40 is no longer going to work, especially if you anticipate that future kind of market sell-offs are going to look more like 2022. So I think as we look forward, I think, building a portfolio that is kind of more properly diversified, that includes things like privates, things like alternatives, I think that is the proper way to build a portfolio. One of the kind of services that we offer when prospective partners or partners kind of join our firm is that we look through the portfolios and we offer this kind of white glove service. So we have an in-house core portfolio management team where they basically just look through the portfolios and look for optimization opportunities, right? So most of the partners that join our firm usually use a 60-40 model. And, once they come on board, we don't force them to use our models and our team. But one of the instant upgrades that we get is using privates and alternatives because instantaneously their portfolios become more efficient, more diversified. So, we do have the framework that allows them to do so. But I do believe as we move forward, portfolio construction involves, that 50-30-20 or whatever that ratio is.
Well, that's the thing, right? I mean, if you look at the 60-40 portfolio, the traditional 60-40 portfolio in terms of risk, in terms of risk budget, it still eludes investors that and probably advisors as well to some degree, that 90% of the risk in that 60-40 portfolio is economic risk, equity risk, as opposed to, fixed income risk, because the risk isn't properly, the risk budget isn't properly allocated. It looks like the portfolio that we've come to know and love, know, trust, and love, which is the 60-40 model.
Yeah.
But the risk X-ray shows a completely different skeleton, right? So that is something that, was very hard to do for advisors for the last 15 years, prior to our conversation. But I think going forward, again, we're in this environment where the environment is demanding that you take the opportunity while you can to make those adjustments, for your client's sake.
And portfolio construction evolves, as you know, over time, right? I mean, we've all seen the chart before where 20 years ago, all you had to do was just ladder out some bonds, and then they went from a more diversified portfolio, 60-40, and now it's evolving into something else. So portfolio construction evolves over time. It's just
the funny thing is that like for the last 10 years, advisors have had their wrists slapped by their clients because they've encouraged adding alternative line items to their clients' portfolios, only to find out, the following year during the review, which is, like, okay, I know why you said to do this or why you recommended, we diversify into these other areas, these other asset types and categories. But, the beta part of the portfolio has rocketed.
Yeah.
Continued to rocket. And so, the advisors like, okay, great. Thanks. Thanks for the diversification advice. But now it's kind of like, the boy who cried wolf.
100%.
Right? It's that's the diversification is always having to say you're sorry.
Yeah. Well, I mean, up until 2022, I mean, you made a good point where the entire industry was pushing alternatives and people were just like, okay, well, stocks are doing great, bonds are doing great. This alternatives is really just high cost product at this point. But after 2022, I think, the goal is, getting alternatives that make sense, structuring in a manner where, you kind of diversify away those kind of bridging kind of scenarios, but also getting it in at a cost-effective way as well, right? That makes sense for all clients, not just your high net worth, but also making it as accessible to smaller clients as well.
Yeah. And from a risk budget or fee budget, rather, point of view, I mean, with beta costing so little and comprising such a, large proportion of most portfolios,
you have more to spend.
You do have more to spend from a fee standpoint on private assets, on alternative asset strategies. And so, Alfred, wow, what a great discussion.
Always a pleasure. It's great catching up.
Great catching up with you too. Thank you so much for your incredibly valuable time and insight.
It was great to be on. Thanks for having me.